There is a highly specific window right now for generating revenue with artificial intelligence, and it is closing rapidly. This is happening because the technology is succeeding at a pace that outstrips the broader market's ability to adapt. This argument focuses specifically on the termination of the low competition era, even as the general utility of AI tools continues to expand. The specific advantage early adopters currently hold is actively dissolving. Economists use the term arbitrage to describe the simultaneous buying and selling of an asset in different markets to profit from a difference in price. In the current digital labor market, we are witnessing a massive execution arbitrage. The immense profitability independent operators see today is tied to a temporary inefficiency in the market. Buyers are paying for outcomes based on older, slower methods, while sellers are generating those exact outcomes using rapid AI execution. In an environment defined by this kind of inefficiency, timing and macroeconomic conditions carry far more weight than individual hustle. You are operating inside an arbitrage window that has a hard expiration date. This chart shows the technology adoption curve, tracing how new tools integrate into society. Right now, in 2026, we are sitting precisely on the transition point between the early adopters and the early majority. This positioning creates a capability gap. Clients and businesses still anchor their pricing to pre-AI human labor constraints. They expect high-level design, coding, or copywriting to require specific amounts of time, effort, and expertise. Meanwhile, the actual execution reality for an AI-equipped operator requires fractions of the time and lower mechanical effort. Skilled operators are currently operating inside this exact void. They deliver senior-level output using AI assistance while charging legacy rates calibrated to a market that hasn't updated its assumptions. Because the cost of production has plummeted for the operator while perceived value remains static, profit margins have expanded to levels typically seen in high-efficiency monopolies. But markets mathematically abhor information gaps. When a discrepancy this large exists between the cost of production and the price of delivery, it acts as a vacuum, triggering systemic corrections that pull prices down to match reality. Building a business model solely on a temporary information gap is unsustainable. The broader market will inevitably adjust to the new baseline of efficiency. The first mechanical force destroying this arbitrage is market price discovery. This is the process where markets seek the true efficient pricing for new acceleration in production. This chart tracks shifting cost curves for digital services. 2026 data shows a 30% fee contraction for design and copywriting. Charging legacy rates requires a client blind to AI efficiency. When expectations update, that gap collapses. Once price discovery completes for a specific service category, the information asymmetry is gone. Clients know how long a task should take with AI assistance, and they price contracts accordingly. The easy arbitrage vanishes. What remains are standard margins reserved for operators possessing actual, scarce skills. You are forced to compete on genuinely differentiated value rather than a hidden speed advantage. The second force is the transition to universal AI fluency. We are moving from an asymmetric technological advantage to standard table stakes. Currently, operators hold leverage because they know how to interact with advanced models, while clients don't. This leverage is a rapidly depreciating asset. This timeline compares our window to the early web. Internet marketing provided massive advantages to businesses simply because they were online, while competitors remained analog. The Web 1.0 advantage vanished once digital presence transformed from a competitive edge into a baseline requirement for every operating business on Earth. Projecting this historical data onto 2026, we see the same pattern. AI tool fluency is becoming the modern equivalent of basic computer literacy. When everyone in the market possesses the same tool, holding that tool ceases to be a competitive differentiator. The third force is the absorption of the human middleman layer. This represents a structural shift in how labor is organized. This flowchart represents current AI service models, with humans acting as a translation interface between client and AI. But as models become capable of parsing nuance without step-by-step guidance, the human layer is compressed. The client interface merges directly with the execution tool. Human strategy, domain expertise, and relationship building remain uniquely scarce commodities. This evolution replaces operators who function solely as manual routers between clients and AI terminals. The business model of, "I use AI to do this task for you," is approaching its expiration date. We translate this into a post-arbitrage playbook. Step 1. Immediate initiation. Delaying income streams while waiting for stability means forfeiting this cycle's easiest capital accumulation phase. Step 2 is layering judgment, transitioning from pure AI executor to domain strategist. In 2028, judgment means specialized domain expertise, solving complex problems requiring human curation overlaid on commoditized AI execution. Step 3 is asset accumulation. Shift your output from transactional labor toward building owned assets. Proprietary data, digital products, and loyal audiences operate on different economic principles than service labor. They are insulated against market price discovery. As the value of transactional labor drops, owned assets hold their structural value. Step 4 is niche fortification. Positioning yourself within a specialization carries compounding advantages. Dominating a narrow niche builds reputation and client relationships. These act as defensive moats against a flood of undifferentiated AI competitors. Step 5 is skill and system building. Surplus capital from 2026 must construct permanent business infrastructure. The ultimate winners of the post-arbitrage landscape will be those who used the current window to fund the development of complex systems. The exact timeline for these shifts will vary by industry. However, these macroeconomic mechanics, market-driven price discovery, and the depreciation of asymmetric tools have remained consistent across every major technological shift of the last century. The framework is visible. The transition is underway. The only variable is whether you continue relying on temporary information gaps or start building the genuine, lasting value required to survive the market correction.